Welcome on back to Armenia from New York. We've talked a lot about your experiences there with Access, Citigroup, and other places. Today I want to ask you a couple of questions on some success cases or real life cases what people have when their approach to money, approach to how they see money, how they behave with money, how that influences their wealth, and to what extent that's important, your personal behavior towards these issues. So let's start with the first kind of point. What would be the most, so to say, real life experience, real case experience with people's behavior with money and how to manage money has led to huge differences in their wealth accumulation and financial security?
Thank you, Samson, very much. I'm so happy to be here, and it's a really great question you're asking. But before I answer the question, I just want to bring up one statistic that I think is relevant to our conversation, which is, and we can look at Armenia, but again, coming from the U.S., I just saw a statistic that said that 43% of Americans could not pay an unexpected bill. An unexpected bill of being roughly about $400. So relevant to American U.S. salary standards, let's say on average, $5,000-$6,000 a month, $400 would be something that 43% of Americans would not be able to pay. They would not be prepared for it.
I can give you another statistic. In Armenia, looked at statistics surveys when only 15% of people have actually used financial institution to save. So 10% of people actually have a bank deposit, which is very bad. It's kind of very low. So hopefully we are moving in the correct direction here with a lot of help from different organizations in the ecosystem. That's maybe a comparable thing.
And that's one of the reasons we are here today, because we do hope that you guys start thinking about all these, although they seem basic, but they're really very crucial to anybody's financial well-being. So let's give some real life examples. And I'm going to bring an example from a book that was written by Morgan Housel, and the name of the book is Psychology of Money. So anyone who hasn't read it yet, I highly recommend it, because it really talks about people's behavioral psychology of how they handle money, how they handle wealth. So I want to talk about I call it the tale of two paths, okay? And these are real life people. The first person I'm going to discuss is an American who is probably the only American whose name coincides with the word janitor and philanthropist at the same time. Ronald Reed was an American janitor who, was a very simple man, and he lived a very simple life. And by American standards, he was probably making something roughly about $30,000 a year, which is very low by American standards, as far as income is concerned, monthly, annual income. And when he died, people were extremely surprised, because he died with, guess how much money? Do you guys want to guess how much money a janitor would have made in his lifetime, making lower than average income for American standards? What do you think? How much do you think he would have?
I don't know, maybe a couple million. I mean, if you really save a lot during many years, that maybe accumulates if you invest that money. But yeah, janitor leaving a huge endowment after him, that's kind of
to be a philanthropist, right? Yeah. Because he left a big portion of that money to charities. So but you mentioned something really crucial. You said saved and invested, right? Mm-hmm. So if he only just saved, it would have been one outcome, and if you save and invest, it's a completely different outcome. So just to let you know, actually, Ronald Reed died with over $8 million in assets. And this was, I think, in 2014, the year 2014, and again, I'm talking about real people here. So he died with over $8 million in assets. And the next question is, people were asking, how did he do that? Did he win the lottery? What happened? How was this man? Oh, by the way, the other very important criteria here, because I want to compare him to another person, is that he was not educated. He had no financial education. This is very important, by the way. He was a simple man. He was a janitor. He had no formal education, and definitely not a financial education.
Yeah.
And all he did, by the way, is, and it's so crazy because, I've been in it so long. To me, everything seems more simple. And sometimes I forget that people get a little concerned about like dealing with money or dealing with investments. But if you really look at it, it's not that difficult. So what Ronald Reed did, by the way, he just bought blue chip stocks. That's it.
Blue chip
stocks.
Like S&P 500, like an index.
Well, I don't think at that time, maybe S&P, that the ETFs weren't as popular as they are now. According to his biography, it says that he invested in blue chip stocks. It's possible he bought individual or he bought it through ETFs or through mutual funds. Mm-hmm. But the point is that he put his money behind large companies and bought blue chip company stocks. They were more predictable in terms of what kind of returns you would be able to get, what kind of dividends you would be able to get. And he just consistently saved. First, very important word, saved a lot of money. Probably more than 50% of his income he saved. And not only he saved, but the reason he was able to amass so much wealth, $8 million, is because he also invested his money. Now, unless you have questions, I want to go to the next person. But tell me if you have any.
No, it's a very interesting case. I guess what's important here to note, if I summarize, basically the discipline of putting some money away from all of your checks that you get in every month, and then you also discipline to invest in certain things, certain strategy, and try and not take the money out, and just be very disciplined about it. Constant saving, constant investment. And in that case, all these things accumulate with time, with compound interest. Things accumulate over the years that he's.
The next magic word, compound interest. And I think it was Einstein who said compound interest is the eighth wonder of the world. The eighth wonder of the world is compound interest.
Yeah, that's one of the key issues in finance that we need to kind of understand how that works. Yeah. But let's get back to that second person you wanted to mention.
Absolutely.
The person that, the janitor basically accumulated at 8 million, probably had a goal of leaving a lot of money behind him to make sure he impacts his surrounding, his communities in a positive manner. But that approach to money, and I'm guessing he kind of accumulated some financial insight, some experience, maybe not a formal one, but he kind of understood what needs to be done and be disciplined about it. But let's do the other case where the person actually, has an income.
So the reason we picked this particular person, by the way, and his name happens to be Richard Fusco. And the reason we're comparing these two individuals because they both died in the same year, 2014.
But this is a recent history.
This is a real case, recent history. Anyway, 2014, in addition to Ronald Reed, there was another person who was in the papers for completely different reasons. And just to compare, let's start with the backgrounds. We said Ronald Reed was he was not educated. He was certainly not educated about money. And then Richard Fusco was the opposite. He was Harvard graduated. He was a financial executive. He worked for Merrill Lynch. Not just worked for Merrill Lynch, he was like an executive at Merrill Lynch. And many people, industry professionals, would praise his knowledge and his expertise about money and finance, and he was able to retire early. And he retired and he lived this extravagant lifestyle. He lived a fun life, and unfortunately, again in 2014, he died penniless. There were many reasons, and I usually compare why. Well, what's the secret? Why, we already discussed why Ronald Reed did well, because he had patience, he had consistency, he, saved, he invested, and he just, had a plan. He stuck to his plan. Richard, he overspent. He lived way beyond his means. But more important than that, there was another thing that usually I typically discuss about different biases that people have when it comes to money and investing. And in this particular case, the bias that Richard Fusco unfortunately was possessed with was the overconfidence bias, because he just thought that he is so knowledgeable about investing that he could not do things wrong. He could not make wrong financial investment decisions. And unfortunately, in 2008, he filed bankruptcy if you recall, 2007, there was a major market crash, financial crisis in the US and in the globe. So overconfidence was one of the other reasons why Harvard graduated professional who had all this training, all this knowledge about money, ends up penniless versus a guy who's just a janitor.
So I think there are a couple of points that I think would be good that we summarize.
Okay.
What's the people's approach to money that they have that influences their way they deal with money? Is it their experience? Is it their background? Is it the families they're born into? Is it the education? What are the things that we can, like a couple of points where we can summarize,
Correct.
Okay, this will influence your behavior towards money and this and this. And how do we afterwards, kind of, maybe we'll have time to look into maybe working on these overconfidence issues, loss aversion. But before we get there, what are these three things, for example, that impact our behavior to money?
So first and foremost, you mentioned this, and it's so interesting because no matter what topic that you discuss, whether it's topic of money or topic of relationships or whatever else you discuss, this point comes up over and over again, which is your childhood, your upbringing is extremely important. One of the major influences that the factors that influence how you deal with money and what is your relationship to money is really your childhood. And I'll give you an example. If you grew up in a household, let's say poor household or unsophisticated household when it comes to finances, and you grew up listening, money is bad, money is dirty, they shame you for wanting to have more money, right? Money gives you anxiety. You start thinking, oh, I can never make it, I can never be wealthy, I can never, I can't save, I don't know what to do, right? Mm-hmm. So you grow up with that mentality. You end up starting to have these belief systems that it ends up for you becoming your truth, right? Yeah. So your childhood, your upbringing is extremely important. Of course, what happens to you even after childhood is also extremely important, right? What experiences you go through. For example, even if you had let's say in comparison to relatively good childhood in a, let's say, middle class environment, and you didn't have this extreme examples of negativity about money, but then you end up making a couple of bad decisions, and then you end up losing your job, and it affects you very terribly. Let's say you have a family, you have a job, you didn't do good enough job to have your emergency fund, which we talk about as financial planners, which basically means you have to have at least 3 months of expenses, your monthly expenses, in a highly liquid environment, in a bank account, let's say high yield money market or a cash account, which is your safety net. I call it your cushion, because if something happens, and it's not an if, it's a when. Yeah. Right? It's not an if. Something's always going to happen. Your car's going to break down, your roof's going to leak, something's going to happen. You're going to break your, arm, or you're going to lose your phone, and there's an we talked about an unexpected bill, and you have to have a plan B for that. And typically plan B is usually putting money aside so you don't have to go into credit cards and so on. But if you go through life where you have extreme cases, let's say you invest money and you live through a market crash, and you see your wealth drop drastically, right? More than 30-40%. Say you have $100,000, all of a sudden because of market crash, your $100,000 is only worth $40,000. Emotionally, psychologically, it's a very tough thing to go through, and it changes people's personalities. It makes them very conservative, right? Yeah. So those things also affect your relationship with money.
So childhood and maybe experiences through life that you have affecting money, and then you get impacted by it.
And your belief systems and your beliefs that you tell yourselves, the subconscious stories that you tell yourself. For example, most unsuccessful people are afraid of trying and afraid of making a mistake, right? So that's one of the big differences between who is successful or who becomes successful or has the potential to be successful versus not. Whether it's about success about money, right? Accumulating wealth, or success about your career or anything else, right? The difference is that the unsuccessful people are afraid to make mistakes, versus successful people say, okay, how can I learn from the mistake? So that's a very, very big important differentiator.
So with regard to the belief system, I think this is important because it's not that successful, unsuccessful. I would say some people have received the information, are willing to take in the information, how the investments work, how important savings are, and they're willing to take in the information and act according to that information. And maybe if you are not willing to take that step on personal development, on building a brighter future financially, I think that will be the difference between the success and non-success. Obviously, you have to try, but you have to make informed decisions.
Absolutely.
And the informed part is what kind of differentiates between how secure you are in the future, whether it's like emergency fund or anything else. And in the first cases, I would also kind of go back to the case of the janitor and this rich person. Obviously, the rich person had a huge amount of income, but still managed to overspend. In the other case, we have a very low income and a lot of investment, savings investment, and wealth accumulation. So it's most of the time, it's not even connected to income. It's basically your discipline, how much of your income
it is so
decide.
true. It's really not connected to income. So it's not about how much money you make.
Yeah.
It's about what you do with it and how much you save. So the amount of wealth that you will accumulate over time is not dependent on how much income you make. It's based on your savings rate.
Exactly. So
The amount of
income
wealth.
does not guarantee wealth. Savings rate guarantees
Savings
wealth.
rate guarantees your rate.
But anyhow,
So just going back to your point, you mentioned something very important, which is investing in yourself, educating yourself.
Yeah.
I can't tell you how important it is because you don't know what you don't know, right? When you make mistakes, you don't know when you make a mistake because you didn't know this was a mistake. Obviously, you wouldn't have made it. So educating yourself is very, very important. There's many different ways you can do that.
And we're not talking about taking a diploma. This is like half an hour a week.
Honestly, everything is on YouTube. You can literally go and educate yourself. And I'm oversimplifying because you can buy books and you can take courses, but you don't need to go to a 4-year university to be able to be successful financially, is what I'm saying.
Okay. Well, I think this should be plenty for today.
I just have one last point, very important, which is the success, your financial success, is not dependent on your income, is not dependent on your technical knowledge about money and investing. It is dependent on your behavior. Your behavior.
Yeah.
It's that simple.
Great.
That's my last point that I wanted to mention.
Thanks, Anna. This is very helpful. This approach to money and behavior to money is really, really critical. And I think we in Armenia have a good kind of progress, good trends being changed. And a lot of people are considering this and moving in the right direction. So thanks for your contributions as well on this.
You're welcome.